Ladies and gentlemen, welcome back to the channel. Archival footage rolls. Frantic traders waving papers on the New York Stock Exchange floor, newspapers flying off presses, grim-faced crowds gathered outside shuttered banks. Against this backdrop, the voiceover cuts in, steady and grave. October 1929. The world watched as the American economy crumbled overnight. The camera lingers on headlines. Wall Street in panic, Black Tuesday, stocks collapse by billions. But then the question lands, one that still echoes nearly a century later. Was it really a surprise? This wasn't just a single moment of financial failure. It was the culmination of years of unchecked speculation, rising inequality, loose credit, and economic illusions. Beneath the glittering surface of the Roaring Twenties, cracks were forming. The American economy was a fragile house of cards, held up by borrowed money and blind confidence. And when it all came crashing down, it didn't just shake Wall Street, it shattered the dreams and livelihoods of millions across the country, and eventually, the world. This story isn't just about numbers or stock tickers. It's about ambition, excess, warnings unheeded, and the human cost of economic collapse. So we ask the central question, what really caused the crash? And what lessons can we still learn from it today? As World War I ended, America emerged, not just victorious, but economically invigorated. The 1920s were dubbed the Roaring Twenties for a reason. Cities buzzed with energy, industries expanded at lightning speed, and optimism flooded the national mood. Factories churned out goods like never before, from automobiles to appliances, and for the first time, ordinary Americans were buying more than just necessities. They were buying dreams. The economy was booming. Industrial output surged, wages rose, at least for some, and unemployment fell. With confidence soaring, Americans looked for new ways to grow their wealth, and the stock market seemed like the perfect vehicle. What had once been the playground of the elite became the new frontier for the middle class. Millions of people, clerks, farmers, housewives, poured their savings into the stock market, believing it would only ever go up. Wall Street wasn't just a financial hub anymore, it became a symbol of modern success and progress. At the same time, consumer culture exploded. New inventions like refrigerators, radios, and vacuum cleaners promised a more modern lifestyle. And with the rise of credit and installment plans, people didn't need to wait until they could afford something. They could buy now and pay later. But this lifestyle of easy credit masked a more fragile truth. Much of the prosperity was built on debt and speculation. Beneath the jazz and glamour, economic inequality was growing. Farmers were already struggling, and the market's rise was increasingly disconnected from real production. And those cracks, though invisible to many at the time, were growing wider, every day. While city dwellers danced in speakeasies and Wall Street speculators watched their paper fortunes multiply, large segments of the population were being left behind. Farmers faced plummeting crop prices and rising debts. Factory workers' wages didn't always keep pace with inflation. And all the while, Americans kept spending money they didn't have, propped up by a booming credit market. The stock market itself became a casino. People borrowed heavily, through margin loans, to buy shares, gambling on a rising market. But this frenzy was built on confidence, not on solid economic fundamentals. Companies were overvalued. Many investors had no real understanding of what they were buying, and the illusion of endless growth blinded even seasoned professionals. The visual rhythm of this section should mirror the energy and imbalance. Fast-paced jazz overlaying lavish city life, then cut sharply to dusty farms, empty pockets, and people stretching paychecks. Graphs spike up rapidly, but begin to flicker and wobble. It was a decade living on borrowed time and borrowed money. All the glamour and confidence of the 1920s was real, yes, but it was also the fuel for one of the greatest financial collapses in history. By the mid to late 1920s, the economics party was in full swing, but warning signs were flashing like red lights in a fog. One of the most dangerous trends was the rise of stock market speculation, particularly the practice of buying on margin. This meant investors could buy stocks by paying only a small fraction of the price up front, sometimes as little as 10%, and borrowing the rest. It worked brilliantly, as long as stock prices kept rising. But if they fell, investors were on the hook for massive debts they couldn't repay. It was financial Jenga, and the tower was wobbling. At the same time, economic inequality was growing. While industrialists and stockholders saw their wealth soar, millions of Americans were barely getting by. The wealth gap meant that much of the country's economic growth was built on the spending of a relatively small elite, while most people depended on credit to maintain the illusion of prosperity. In rural America, farmers were already deep in crisis. After WWI, global demand for American crops plummeted, but farmers kept producing, hoping things would bounce back. Instead, prices collapsed. Overproduction led to warehouses full of unsold goods and farmers crushed by debt. Many were losing their land or walking away from it entirely. Roger Babson, a respected economist and businessman, was one of the few voices willing to challenge the dominant optimism of the 1920s. In September 1929, just a month before the crash, he famously declared, "Sooner or later, a crash is coming, and it may be terrific." This wasn't idle speculation. Babson had studied market trends, debt levels, and the speculative mania gripping the country. He saw the disconnect between soaring stock prices and the actual performance of companies. But in a decade obsessed with growth and glamour, bad news was unwelcome. The culture of the time was intoxicating. Newspapers hailed each new high on the stock market as proof that America had entered a new era of permanent prosperity. Wall Street magnates like Charles Mitchell reassured investors that the market was fundamentally sound. Even President Herbert Hoover had claimed that America was closer to the final triumph over poverty than ever before. Anyone who questioned this golden narrative was labeled a pessimist, or worse, unpatriotic. What this created was a feedback loop of denial. As prices rose, more people rushed in to invest, afraid of missing out. Banks issued risky loans, brokers extended credit freely, and average Americans, some of them with modest incomes, began putting their life savings into stocks. No one wanted to pull out and miss the next big gain. It became a collective illusion. Everyone believed the good times would go on forever. Behind the scenes, however, the fundamentals were crumbling. Company earnings couldn't keep up with their inflated stock prices. Margin debt was at an all-time high. Consumer debt was growing faster than wages. And underneath the glittering skyline of American cities, rural areas, and industrial sectors were already slipping into recession. The tragic irony is that the warnings were there. They just didn't fit the story people wanted to believe. The country wasn't just blind to the cliff. It was racing toward it at full speed, with everyone cheering from the sidelines. By the time reality hit, it was far too late to turn back. Chacker's crash didn't happen all at once. It unfolded over several terrifying days that shook the foundations of the American economy. October 24, 1929, Black Thursday. It started with a ripple. As trading opened on the New York Stock Exchange, a massive wave of selling hit the floor. Nearly 13 million shares changed hands, an unprecedented volume. Prices plummeted and chaos erupted. Crowds gathered outside, Wall Street watching in stunned silence. Brokers screamed orders into phones. The ticker tape, normally a few minutes behind real time, fell hours behind. Major bankers tried to step in with a show of confidence, pooling millions to stabilize prices, but the panic had taken root. October 28th, Black Monday. That weekend did nothing to calm the markets. When trading resumed, fear turned to frenzy. The Dow Jones dropped nearly 13% in a single day, its largest decline up to that point. Rumors swirled of bankruptcies, failing banks, and ruined fortunes. Margin calls went out to investors who had bought stocks on credit, demanding immediate payment. But most had no cash to cover their losses. Many were forced to sell at a steep loss, which only drove prices down further. October 29th, Black Tuesday. Then came the day that would become infamous. Over 16 million shares were traded, and billions of dollars in market value evaporated. Stock prices collapsed with terrifying speed. Companies that had been worth hundreds of dollars per share became nearly worthless. Panic selling became widespread. People were no longer trying to make money. They were trying to salvage whatever they could. Across the country, the effects were immediate and devastating. People who had invested their life savings, Teachers, factory workers, store clerks lost everything. Some stories are legendary, like the investor who jumped from a skyscraper after losing his fortune, or the retired couple whose modest savings vanished in a single morning. Banks that had speculated in the market began to fail, and depositors, finding their accounts suddenly frozen, rushed to withdraw what little remained. It was too late. The Great Crash of 1929 marked more than just a collapse in the stock market. It marked the collapse of a national dream. For years, Americans had been sold the idea that prosperity was within anyone's reach, that the stock market was a surefire path to wealth, and that the economy would keep expanding forever. When that belief system fell apart, it left behind not just bankrupt bank accounts, but a deep psychological wound. Families who had carefully saved saw their security vanish overnight. Parents who had once promised better futures for their children now stood in breadlines. Businesses shuttered, entire communities crumbled. Trust in institutions, banks, government, Wall Street, was deeply shaken. The emotional toll ran deep, with fear and uncertainty replacing the confidence and optimism of the 1920s. People no longer believed the system was fair, or that it worked in their favor. In the years to follow, this shattered confidence would fuel political upheaval, government reform, and a widespread reevaluation of what economic security really meant. The crash didn't just signal the end of a financial boom, it marked the beginning of America's long struggle to rebuild its faith in itself. In the immediate aftermath of the crash, the ripple effects were swift and brutal. Banks, many of which had invested heavily in the stock market or had lent recklessly, collapsed by the hundreds. With no federal insurance, depositors lost everything. Businesses, now cut off from credit and facing plummeting consumer demand, shut their doors. Within months, millions of Americans were out of work. By 1933, unemployment would soar to over 25%, with cities like Toledo and Detroit seeing jobless rates nearing 80%. The desperation was visible everywhere. Once thriving city streets now hosted endless bread lines and soup kitchens. Families who had never asked for help now waited for hours just to get a meal. Tent cities, nicknamed Hoovervilles after President Herbert Hoover, sprang up on the edges of towns, filled with families who had lost their homes. The emotional and psychological toll of the Great Depression was unlike anything the American public had ever experienced before. For many, their identity had been tied to their work, their ability to provide for their families, and their belief in the American dream, that anyone could succeed through hard work and determination. The stock market crash and subsequent economic collapse shattered that belief. Suddenly, people who had once been successful found themselves living in destitution, losing homes, businesses, and savings. The hardest hit were the men who had traditionally been the breadwinners. To them, losing their ability to provide wasn't just a financial crisis, it was an existential one. The shame of not being able to care for their families or fulfill their roles as protectors and providers was overwhelming. It wasn't just a matter of losing money. It was losing their sense of purpose, their dignity, and their place in society. For many, this sense of helplessness and failure led to a tragic increase in suicide rates, with men often taking their own lives as they saw no way out of their financial ruin. The women and children affected by the Depression faced a different kind of despair. Women had to take on jobs, often in dire conditions, just to feed their families. But even as they worked tirelessly, many felt the sting of judgment for having to step outside traditional gender roles. Meanwhile, children saw their parents struggle in ways they had never imagined. The dreams they had once held for their futures were replaced with fear, uncertainty, and the need to survive day to day. The sense of hopelessness permeated the country. The emotional scars were visible in the faces of the people. Eyes that had once been filled with hope now reflected uncertainty and exhaustion. The images of people standing in bread lines, mothers pushing shopping carts with empty hands, and fathers walking the streets looking for work all convey the weight of that psychological toll. The trauma wasn't just economic, it was cultural. The crash had shaken the very foundation of the American spirit. This despair was magnified by the collapse of trust in the institutions that had once promised prosperity. Banks failed, businesses crumbled, And the government, despite President Hoover's initial efforts, seemed ineffective in addressing the depth of the crisis. People had lost faith, not only in their financial system but also in their government's ability to protect them from such a catastrophe. The Great Depression wasn't just a national economic crisis, it was a crisis of identity. It challenged everything Americans had believed about themselves, their self-reliance, their ability to rise above adversity, and their inherent worth based on success. It led to a profound reevaluation of what it meant to be American in a world that seemed increasingly beyond control. The recovery from the Depression took not just a new economic plan, but a transformation in the national psyche. The New Deal programs, Social Security, and other reforms would eventually help restore some sense of security, but the scars of the Depression would linger for generations. The emotional and psychological wounds of those who lived through it were deep, and many of them would never fully heal. It was a reminder that prosperity can be fragile, and even the strongest economies can be brought down by systemic flaws, unchecked speculation, and a refusal to listen to the warning signs. As the effects of the crash reverberated through the nation, President Herbert Hoover's initial response was widely seen as inadequate. Hoover, a businessman by trade, believed that the economy would eventually right itself if left alone. He encouraged volunteerism and local efforts, but his faith in the free market's self-correcting nature quickly proved to be misplaced. As unemployment soared and the suffering deepened, his policies seemed to offer little relief. The American people were disillusioned, and Hoover's popularity plummeted. The public grew increasingly impatient, turning to the idea of a more proactive government intervention. This climate of frustration and despair set the stage for the rise of Franklin D. Roosevelt. When Roosevelt campaigned for the presidency, in 1932 he promised a new deal for the American people, an active role for the federal government in easing the nation's suffering and preventing future economic crises. His optimistic rhetoric and promises of bold action resonated with a country desperate for change. Upon taking office in March 1933, Roosevelt wasted no time implementing his reforms. The first 100 days of his presidency became a whirlwind of legislative action. One of his earliest moves was the Emergency Banking Relief Act, which aimed to stabilize the banking system by allowing only solvent banks to reopen and restoring public confidence in financial institutions. This act was the first step toward Roosevelt's broader goal: rebuilding trust in the American economy. The creation of the Securities and Exchange Commission, SEC, in 1934 was another pivotal moment. The SEC was tasked with regulating the stock market to prevent the kind of speculation that had led to the crash. By requiring companies to disclose their financial information, it sought to restore transparency and fairness, ensuring that investors had access to accurate data to make informed decisions. It was a major step toward creating a more stable and equitable financial system. Roosevelt also pushed for the Glass-Steagall Act, which separated commercial and investment banking. This move was designed to prevent the risky practices that had contributed to the crash, such as banks using depositors' savings to speculate in the stock market. The Glass-Steagall Act aimed to protect everyday people's savings while stabilizing the financial system. This measure, along with the Federal Deposit Insurance Corporation, FDIC, established by the same law, ensured that bank deposits were insured up to a certain amount, providing a safety net for American families. Perhaps the most transformative piece of Roosevelt's New Deal was the Social Security Act of 1935. In the midst of widespread poverty and unemployment, Social Security provided a lifeline for the elderly, the disabled, and the unemployed. It established a federal safety net that guaranteed assistance to those in need, fundamentally changing the role of the government in providing for the welfare of its citizens. The creation of Social Security also marked the beginning of the modern welfare state, a legacy that endures to this day. Through these reforms, Roosevelt's New Deal aimed to not only recover the American economy, but also reshape the relationship between government and the people. The government, once seen as a distant and passive force, became an active participant in ensuring economic stability and protecting the most vulnerable members of society. Roosevelt's approach was radical for its time, but it provided hope and tangible relief to millions, helping to restore confidence in the American system. While the New Deal didn't immediately end the Great Depression, some argue it was the onset of World War II that truly pulled America out of the economic slump. It fundamentally altered the role of the federal government in the lives of Americans. It laid the groundwork for future social safety nets, economic regulation, and the expectation that the government has a responsibility to intervene in times of national crisis. The impact of the New Deal, though controversial in some quarters, can still be felt in policies and programs that exist today. There are a number of myths surrounding the 1929 crash and the Great Depression that have persisted over time, and understanding the reality behind them can provide a more accurate picture of what really happened. One of the most pervasive myths is that everyone lost everything in the stock market crash of 1929. While it's true that millions of Americans lost money, particularly those who were heavily invested in stocks, it's important to remember that not everyone was involved in the market. In fact, only about 10% of Americans were invested in the stock market at the time. For those who had no stock investments, life went on, though the broader economic collapse still affected them, as unemployment soared and the economy contracted. Another myth is that the crash directly caused the Great Depression. The crash was certainly a significant trigger, but it wasn't the sole cause of the economic downturn. The Great Depression was the result of a combination of factors, both in the U.S. and globally. In fact, the stock market crash of 1929 only marked the beginning of a much deeper, longer crisis. The Depression was caused by the collapse of international trade, the Dust Bowl agricultural disasters, and poor banking practices that led to widespread failures and loss of credit. In addition, the Federal Reserve's tightening of the money supply in the early 1930s exacerbated the situation, leading to deflation, mass unemployment, and the collapse of many industries. Another misconception is the idea that the Depression was purely an American problem. While the crash began in the United States, its ripple effects were felt across the world. The global economy was highly interconnected at the time, especially in Europe, which was still reeling from the effects of World War I. In Germany, for instance, the economic fallout of the Depression contributed to the rise of Adolf Hitler and the Nazi Party, as people were desperate for change. In many parts of Europe, including Britain and France, unemployment soared and political instability grew as a result of the global economic crisis. The U.S. was certainly at the epicenter of the Depression, but the effects were worldwide, deepening political and economic instability in other countries. Finally, there's the myth that the New Deal ended the Great Depression. While the New Deal provided much-needed relief and began to reshape the American economy, it didn't end the Depression by itself. The reality is that the Depression lasted until the early 1940s, and it was the onset of World War II and the resulting military production that fully revived the U.S. economy. World War II provided the necessary boost in industrial output and job creation that ultimately pulled the country out of the economic slump. The New Deal laid the groundwork for future reforms, but it was the wartime economy that finally ended the Depression. The 1929 stock market crash is often portrayed as the singular event that triggered the Great Depression. While it was certainly a catastrophic moment, it's important to recognize that the Depression's roots were much deeper, and the consequences far more wide-ranging than a single financial collapse. To truly understand the causes and effects of the Great Depression, we must look beyond the crash itself and examine the interplay of economic, political, and social factors that created the perfect storm. Economic factors. The 1920s were a period of rapid growth, particularly in the stock market, but much of this growth was built on shaky foundations. While the stock market boomed, much of it was driven by speculation. Many investors were buying on margin, essentially borrowing money to buy stocks, believing that stock prices would continue to rise indefinitely. When the market began to slow down, those who had borrowed heavily found themselves unable to repay their debts, triggering a panic. However, the crash was not simply the result of speculative excess. It was also a reflection of deeper economic imbalances, such as underconsumption, income inequality, and a dependence on a few key industries. The 1920s saw mass production and industrialization, but this prosperity was not evenly distributed. Workers in many sectors faced stagnant wages, while a small percentage of the population saw massive wealth accumulation. This contributed to an economy where the wealthy could purchase luxury goods, but many others could not afford even basic necessities. As a result, industries faced overproduction, especially in agriculture, where farmers were struggling to sell their crops. When prices for goods began to fall, the economy began to spiral. The agricultural crisis. The agricultural crisis was another key factor that contributed to the Depression. Farmers in the U.S. were already struggling long before the stock market crash. The demand for agricultural products had been high during World War I, but after the war ended, demand dropped, leaving farmers with surplus crops and plummeting prices. Many farmers were deeply in debt, having borrowed money to finance the production of their crops during the war. When crop prices fell and they could no longer pay back their loans, this led to foreclosures, further economic distress in rural areas, and exacerbated the overall economic downturn. International factors. The Depression wasn't just an American issue, it was a global phenomenon. The U.S. economy was intricately tied to other nations, particularly in Europe. In the wake of World War I, many European nations were economically unstable, and the global financial system was on shaky ground. The U.S. had loaned money to European countries, and when the American economy crashed, these countries were also unable to repay their debts. The global nature of the Depression meant that even countries that weren't as directly impacted by the stock market crash still faced severe economic problems, including high unemployment, political instability, and social unrest. The role of the Federal Reserve. Another critical factor in the Depression was the role of the Federal Reserve. In the years following the crash, the Federal Reserve raised interest rates in an attempt to preserve the value of the dollar. However, this action reduced the money supply and made borrowing more expensive, which deepened the economic contraction. Many economists argue that the Federal Reserve's policies during this period made the Depression worse, slowing down recovery by restricting access to credit when businesses and consumers needed it most. Political and social factors. Politically, the initial inaction of President Herbert Hoover played a significant role in the deepening of the Depression. Hoover was deeply committed to the idea that the economy would correct itself without government intervention, a belief rooted in classical economic theory. As a result, he resisted calls for more direct intervention, leaving many Americans to suffer without adequate government support. Socially, the Depression caused widespread human suffering. As banks failed and businesses shut down, millions of Americans lost their savings, their jobs, and their homes. The psychological toll was immense. Unemployment rates soared, and for the first time in American history, large numbers of people were reliant on government aid to survive. Soup lines and Hoovervilles, makeshift homeless encampments named after Hoover, became a tragic symbol of the times. Long-term consequences. The Great Depression reshaped the political and social landscape of the U.S. and much of the world. In Zeitzeitenweiz, the U.S. Franklin D. Roosevelt's New Deal sought to provide relief to those suffering, reform the financial system to prevent future crashes, and foster recovery through large-scale public works programs. The New Deal marked a fundamental shift in the role of the federal government, establishing the idea that the government should actively intervene in the economy to protect citizens from the worst economic excesses. Globally, the Depression contributed to political instability in many countries. In Germany, the economic crisis played a major role in the rise of Adolf Hitler and the Nazi Party, while in Italy, Benito Mussolini's fascist regime gained ground. The global economic turmoil also set the stage for World War II, as nations began to turn inward, focusing on their own survival at the expense of international cooperation. The myths and the reality. One of the biggest myths surrounding the Depression is the idea that it was solely caused by the stock market crash. The crash was certainly a catalyst, but it was the culmination of several years of economic imbalance, inequality, and international instability. The Depression was not a single event. It was a slow-moving crisis that took years to unfold and that required complex responses to resolve. Another myth is the idea that the Depression was caused by a lack of government intervention. While it's true that Hoover's initial response was insufficient, the reality is that many of the policies implemented during the New Deal did not immediately end the Depression. The economic recovery was slow, and it wasn't until World War II that the economy fully rebounded. In essence, the Great Depression was a multifaceted event with many contributing factors. It wasn't just a result of financial speculation or market excess. It was a deep structural crisis that revealed weaknesses in the American and global economy. By understanding the complexity of the Depression and the factors that contributed to it, we gain a more nuanced perspective on how history unfolded and how societies can better prepare for future economic crises. Separating myth from reality allows us to learn from the past, shaping our understanding of economics, politics, and society for generations to come. The lessons of the Great Depression resonate strongly in today's world, offering valuable insights into the dangers of unchecked speculation, financial deregulation, and growing wealth disparity. While the specifics of the 1929 crash differ from modern events, the patterns and underlying causes remain strikingly similar. By drawing parallels between the past and the present, we can better understand the forces that drive economic instability and the importance of financial literacy and sound economic policy. One of the most evident parallels is the recurring cycle of stock market bubbles. Just as the 1920s stock market was driven by rampant speculation and an overestimation of asset values, we've seen similar behavior in recent decades. The dot-com bubble of the late 1990s, which saw tech stocks skyrocket on little more than hype, mirrored the speculative frenzy of the 1920s. Investors poured money into companies with little understanding of their true value, resulting in massive losses when the bubble burst in 2000. Similarly, the 2008 financial crisis was largely driven by the housing market bubble, where subprime mortgages were bundled and sold as low-risk investments. When the bubble burst, it triggered a global financial collapse. In all these cases, the underlying issue is the same: people investing based on the belief that prices will continue to rise without regard for the fundamental value of the assets in question. This speculative behavior is often fueled by a sense of euphoria and a belief that the market will continue to grow indefinitely. However, history shows us that markets can, and do, collapse, sometimes dramatically, when reality catches up with speculative excess. Deregulation is another critical issue that echoes through both the Great Depression and modern financial crises. In the years leading up to the stock market crash of 1929, the financial sector enjoyed a degree of deregulation that allowed for risky practices such as buying on margin, where investors could borrow money to buy more stock than they could afford. This created a fragile system where small downturns led to massive losses, triggering a domino effect of panic selling. Similarly, in the years leading up to the 2008 crisis, a series of deregulatory measures in the banking and housing sectors allowed financial institutions to take on increasingly risky loans and securities. When these loans failed, the entire financial system was at risk. The issue of wealth disparity is another crucial lesson that the Great Depression offers for today. In the 1920s, the economic boom primarily benefited the wealthiest Americans, while much of the population faced stagnant wages and economic insecurity. This disparity contributed to an over-reliance on credit and speculative investments to sustain the illusion of prosperity. Today, we are witnessing growing wealth inequality, where a small percentage of the population holds a disproportionate share of wealth, while many workers face rising costs of living, stagnant wages, and limited access to economic opportunities. This growing inequality can fuel economic instability, as it creates an economy where the majority of people are unable to contribute to sustainable growth, relying instead on debt and short-term financial solutions to meet their needs. Understanding these lessons is essential for financial literacy and economic policy. As individuals, we must recognize the risks of speculation and leverage. Investing without understanding the true value of assets and relying too heavily on credit can lead to personal financial ruin, as it did for so many during the Depression. On a broader level, policymakers must recognize the dangers of unchecked deregulation, the need for robust financial oversight, and the importance of addressing wealth inequality. In the wake of the 2008 crisis, some reforms were put in place, such as the Dodd-Frank Act, designed to prevent another financial meltdown. However, it's crucial that we remain vigilant and ensure that these policies are enforced and continue to adapt to an ever-evolving financial landscape. Ultimately, the key lesson is that economic systems are fragile, and the consequences of ignoring the lessons of history can be devastating. By learning from the past, we can better prepare for future economic challenges and avoid repeating the mistakes that led to the Great Depression. Financial literacy, understanding the risks, the fundamentals of investing, and the broader economic forces at play is more crucial than ever. And on a larger scale, governments must prioritize policies that promote long-term economic stability, fairness, and shared prosperity. History matters, and it's through the lens of past crises that we can better shape a future that avoids the same pitfalls. As we close the chapter on the Great Depression, it's crucial to remember the human cost of this crisis: the lives lost to financial ruin, the families torn apart, and the enduring sense of insecurity that followed. The Depression left deep scars on American society, reshaping everything from financial policy to the American dream itself. But it also left a legacy, a reminder of the fragility of economic systems and the vital need for caution, oversight, and empathy in the face of financial systems that benefit a few while leaving many vulnerable. Final thought: history doesn't repeat, but it often rhymes. We've seen the echoes of past financial bubbles, crashes, and their aftermaths in recent years. The question remains: will we learn from the lessons of the past, or will we allow the same mistakes to unfold again? Call to action. If you found this deep dive into the Great Depression eye-opening, don't forget to subscribe for more hidden stories from history that continue to shape our present and future. And I'd love to hear your thoughts in the comments below. Could something like this happen again? Let's talk about the economic lessons we should be taking with us as we move forward.